Hi there, everybody. Welcome. It is time to get started, and thank you for being with us today. We have traders attending this workshop from everywhere around the world, so whatever time it may be where you live, I hope you're having a good day. I know these are tough times for many people, so we do hope that you and your family are well and safe. This is Craig at Max Trading. Chris and Eusebio are here with me, and we are very glad to include you in the Max community today. Also, other traders will be joining us later by video, and we welcome you as well. Thanks for your time and letting us share with you today. It is true that the COVID virus has made life difficult for a lot of people, but I do love it that trading can be done safely within your own home. This may be the most ideal time for you to learn a very profitable system, and we love having the opportunity to show you this very productive way to trade. It really is an exciting time for us because we are so intimately acquainted with the Max trading system. We have been trading it for more than 10 years, and we know it is a game changer for traders of all different skill levels. Everyone will love the confidence and the success that comes with a tried and proven system. More than 2,000 traders have graduated from a Max trading course. That's a lot of training, and we've learned how to do it extremely well over the years. You will get the help that you need and more. In fact, on the 10th of September, we begin our 70th ETF standard course, where you can learn a very profitable system, very flexible system, excellent for all markets and all time frames. If you like the excitement of fast-moving charts, let's say 1 minute to 5 minute time frames, you will love Max trading. Or if you perform better on a slower chart, perhaps a 15 or 30 minute chart, Max is also for you. Or maybe you need a lot of time away from your computer, and so you like a 4-hour or an 8-hour or a daily chart. Max is perfect for you also. I helped one of our members recently set up 12-hour charts. He's very excited, looking forward to trading that longer time frame. And if your preferred market is YM, ES, DAX, some other indice, or Forex pairs or commodities, options, maybe stocks, Max is for you. Very flexible, very powerful. And with Max, you also get a great trading community. Many of you will be taking a Max course with us in just a few days now, and that gives you a lifetime Max membership. So we'll be looking forward to trading with you for many years to come. The Max community is not only a fun place to be, lots of good camaraderie, and although that's important, it's also important that you get a wealth of ongoing support and unending assistance. As much as you need, as much as you will ask for, it's there for you, along with free trading workshops at least 2 or 3 weekends every month that allow you to continue improving your skills. You know that new ideas can be very important because the markets are constantly changing, and so these new ideas help us to meet new challenges. Eusebio helped us do this just not too long ago by developing a solution that we call the Max Enhanced Trade Format Indicator, which is a lot to say. That's a real mouthful. We just call it the ETF, Enhanced Trade Format. It has proven itself to be a very effective addition to Max Trading, and I'm confident you will love it. And you get that indicator, no extra charge, along with the companion, also at no extra charge, and it just comes with your Max training. The companion, by the way, is our price directional bias indicator. It makes a huge difference in your results. And all of these things taken together, the professional training, correct price action analysis, knowledgeable global context, indicators that are actually effective, a supportive community for a lifetime of trading. These things combine and give you an excellent shot at the kind of trading that will make a difference in your life. And by the way, No, we do not expect you to just take our word for it. We want you to see it for yourself. I will be sending you an invitation to attend a live trading session, real-time charts, scheduled for this Tuesday, the 1st of September. You'll get to see on real-time charts the effectiveness of this system. And you know, the great thing about live charts is there's no way to exaggerate. You can't hide. Everything is right there out in the open for everybody to see. And I hope you can attend Tuesday or at least watch the video playback. So when I send you the playback of today's webinar, I will include a link so that you can have a free seat at Tuesday's live trading event. So thank you again for attending today. If you have questions, please ask. You can do that anytime. We'll do our very best to make sure that every question is answered. Eusebio is the developer of ETF as well as the companion. He has traded the MAX system full-time for many years. He's the perfect choice to give us all the details about MAX trading. Not only is Eusebio a very good trader, he's also a skilled teacher. And you know what I really like? I really like the genuine pleasure that he so obviously feels in helping his fellow traders. I love that. Eusebio, thank you. We're grateful for everything that you do and for taking time with us today. I'll pass the microphone along to you.
Thank you very much, Craig. Welcome to everyone who is attending this presentation, either the live presentation or through the video, which will be available. So, I am a MAX instructor since 2009. Unfortunately, after Dr. Jim Pruitt, who has designed and developed the MAX trading system, passed away, his two partners, Chris and Craig, have asked me to become an instructor, and I have accepted that with great pleasure. Personally, my past activity was being a software engineer as a service manager for around 30 years, and I have had the privilege for the last 15 years of my career to work with banks, important banks in Europe, in France, of course, because I live in France, in Germany, in Switzerland, in Luxembourg, in Belgium, in UK, and this has given me the opportunity to be in contact with traders from these banks, and I have learned a lot from them. And so we have some of their concepts, so in the MAX trading system, by the way. But I am also passionate with investing and trading for more than 35 years now in almost all the markets. Of course, the Forex market, but also the futures market, the stock market, the options market, and just a little bit the bonds market, because the bonds market is a very important market to follow to understand what I call the global context. I will explain a little more later. And I am personally a full-time trader also since 2008. Using the MAX trading system. I was a part-time trader before that, but a full-time trader essentially in the Forex since 2008. So now let's go to the MAX itself. So we can ask the question, for whom is the MAX trading system appropriate? And in fact, it is appropriate for a lot of people. If you are an experienced trader and you want to improve your consistency in applying a trading process and in producing profits, then certainly the MAX is for you. If you are a full-time trader, whatever the market you are trading, and you want to multiply your profit to increase your profit, certainly the MAX is for you. But if you are not profitable yet, if you are struggling in your trading process and in the result you get from your trading, then the MAX is certainly for you. And if you are completely a beginner in trading, if you are a new trader looking for a very reliable but also flexible trading system or trading method, I like to use the word method instead of system, because the MAX is an entire methodology. So the MAX is certainly for you too. And so the advantage of the MAX as a trading system is you can decide to work from home. And so if you desire to work from home, then the MAX is certainly for you. And the MAX can provide a lot of objectives to achieve if you want to plan for your retirement, if you want to complement your revenue, if you want to make a living only from trading, then the MAX is certainly also for you, and it's perfectly adequate for that. So the MAX has been created many years ago, so by Dr. Jim Pruitt, named Tiger. It's his nickname his student has given to him because of his strong temperament, and being rolled by the tiger was a tremendous, amazing experience. Believe me, I have been in that case in 2008 when I was his student, one of his students. But anyway, so the Tiger has developed the MAX trading system, and the MAX in fact is an acronym for three important concepts on which the MAX is based on. The M stands for momentum. We want indeed to open a trade when we are sure that there is momentum in the price of the instrument we want to trade, but also volatility. But the acronym take only into account the momentum, so the M. The A stands for acceleration. Acceleration does not mean here that we have to see the price accelerating somewhat. But in fact, it is a process allowing us to increase the profit we can extract from a trend we are trading by a scaling process. And I will explain a little more the scaling process in a few moments. And the X stands for exit. Indeed, once we open a trade, later we have to close the trade. And we have several ways to close the trade. We can make a partial close, or we can make a total or final close. And this will be extremely important for one of the pillars of the MAX, I mean the trade risk management and the money management. But essentially, the MAX is a trend-following system or a trend-following method. In the past, we were making the distinction between a trend-following and a counter-trend following approach, but now we have, simply because we have redefined what a movement or a trend is, we have only the concept of trend trading. But it is associated with a very strict trade risk management and money management approach. This is one of the essential aspects of any trading system. And another aspect I like to add, because it is one of the three pillars of any trading system, so the system itself, the money management, but also understanding the global context. I will explain later what I mean by the global context. And as Craig has just mentioned, so the MAX may be applied to any time frame, not only the standard time frame your platform can provide you with, but also any time frame you can design. For example, we have traders trading in the 12-hour time frame, but also in the 8-hour time frame or the 6-hour time frame, or in non-standard time frame like using constant range bar chart or Renko bar chart or tick chart and so on. And in any market, so as Craig has mentioned a few moments ago. And so, before describing a little more in detail some of the concepts of the MAX, and to thank you for your presence today in this presentation, I would like to give you three important tips we are using in the MAX. And these are three trading tips you can apply even if you're in your own trading process, if you have one trading system. And these three tips will improve your trading. And you will understand why they will improve your trading. And after that, I will show you, I will illustrate you with some chart, some recent trade, what the MAX is. So the three tips I will describe now in a moment will be how to recognize a divergence and how to use the divergence concept. What can we do with a long bar? And how can we reduce the risk when we are in a trade? Because, of course, the ideal situation when we are in a trade is when the trade becomes a risk-free trade or a guaranteed profitable trade. And so let's describe, first of all, these three tips. So the first tip is recognizing a divergence. In fact, to recognize a divergence, we have always to compare the price behavior with the behavior of an oscillator, an indicator, an oscillator. And the one we are using, and I'm illustrating on this chart, is the stochastic of the RSI, and we use an abbreviation for that. We call it the STO-RSI. The STO-RSI is a very nice indicator to pinpoint divergences because it's a mixture of the RSI, which is sometimes too slow, and the stochastic, which is sometimes too fast. But combining both, it's making the job we want for that oscillator to do. And basically, a divergence is when the price behavior and the indicator behavior are different. But we need to be precise. And let's illustrate that idea with that example. We can see that here the price is moving in a downtrend. And at some point, the price is making two lower lows. Let me take my red spot here. It will be easier to pinpoint on the chart. So we have a first low here, and then we have a lower low here in the price. Corresponding to these two lows on the price, we have two corresponding lows in the STO-RSI. Now the STO-RSI is an indicator which has the particularity to sometimes be exactly coincident with the price. Sometimes it's like a little bit by 1 or maximum 2 bars with the price, but sometimes it leads also the price. But anyway, we don't need to have an exact correspondence between the low of the price and the low of the indicator. We just pinpoint, we just put in correspondence the low in the price with the corresponding low in the STO-RSI. And so we have to see two lower lows in the price and two higher lows in the STO-RSI. But there are other rules we describe in the course to be more precise, because of course, in order to recognize a divergence, we need to be extremely precise in order to avoid subjective decision about the divergence. If we take an arbitrary low in the price and in the STO-RSI, we can always find divergences on the chart. But this is not good. And so we have precise rules to define what a divergence is. For example, we need to observe two successive lows in the price and in the indicator. So we have two lower lows in the price, two higher lows in the STO-RSI. So we have a first divergence, and when the divergence is validated, then we can decide that that divergence, if the price follow through, so continue to pull back, we can decide to make a partial exit. In fact, the STO-RSI divergence will be one of our exit technique. Now, what is a partial exit? We call a partial exit an MX, a momentum exit, because we have a loss in momentum indicated by the divergence. Whenever we open a trade, the trade is considered being made of 2 units. Of course, the way to calculate the size of these 2 units is described in the course through the position sizing concept. So 2 units. And when we have to consider a partial exit, an MX, so we close, in fact, 1 unit, leaving 1 open unit to profit from the fact that the price will possibly resume the trend, and so we can catch a larger profit on the trade for that trade. And so this first divergence gives a first exit. Later on, the price make again two successive lower lows in the price and 2 successive higher lows in the STO-RSI, giving another divergence, and so another partial exit. So here an exit number 2. And so we close the second unit. And if we have a more open unit through scalings, we can see that later we have another divergence in the between the price and the oscillator. We have again 2 lower lows in the price and 2 higher lows in the indicator. So we can consider another exit. So, and you can see how many pips each of these exits are making. And so we can calculate the total result of the trade by adding the pips of each unit. We divide by the number of units, and then we divide by the stop loss size in order to get the reward to risk ratio. Of course, the divergence is one of the numerous exit techniques we have within the MAX. It is an important one, but we have many other exit techniques based on indicators, exit technique based on price action, exit technique based on a combination of price action and one indicator, exit techniques based on time consideration during the day, and so on and so on. So another example of the divergence now in an uptrend is the following. So the price is moving upward, and so this time we compare the highs of the price with the highs of the oscillator. And whenever the price makes two successive higher highs, and we observe two successive lower highs in the RSI, corresponding highs, of course, then we have again a divergence. And this divergence is an opportunity to make an exit if the price follows through. What do I mean by the price following through? Once we have identified the candles for which the divergence appear, this is called the setup bar. And once we have a setup bar, we have then to define an exit level with a very simple rule. And if the price hits that exit level, then we make our partial exit. If the price does not hit that level, we make nothing. We stay in the trade with our units. And later on, we have other higher highs in the price, lower highs in the RSI, we make a partial exit, and then later on we have another divergence, and so we can, for example, make a full exit if we are in a situation to make a full exit. So this divergence, and in the max we have several types of divergence. I have just illustrated here the basic case of the divergence, but we have in fact 4 types of divergences from basics to complex types of divergence, allowing us to optimize our exit technique with just that indicator. So this is for the first tip using divergence, and you can use any momentum oscillator you want. You can use, for example, a momentum oscillator. You can use, for example, overbought, oversold oscillator. So any kind of momentum oscillator. The second tip, which is an extremely important tip based on pure price action, is the concept of the long bars. What is a long bar? So a long bar is a specific candle moving in the direction of the price, of the trend. For example, with this blue bar, we are in an uptrend, and so this blue bar here, where I have drawn my magenta vertical dashed line, is a long bar. And a long bar is a bar having a length which largely exceeds the average length of the previous candles. For example, 2 times or more the average length of the previous candles. And whenever the price makes such a nice movement, and usually a fast movement for no reason, the price is always moving nicely in our favor, and this is a nice opportunity to bank some profit. And usually, after having made a profit on a long bar, the trade, if we furthermore adjust our stop loss, the trade becomes a risk-free trade. Not always, but very, very often. And why the long bar is a good opportunity to make a partial profit? In fact, because what we observe for years and years and years now, and I'm observing that since the beginning of the 90s, in fact, whenever the price makes a long bar, 2 out of 3 times the price makes a pullback. It may be a small pullback, it may be a large pullback, it may be also a reversal. Because in fact, a reversal always starts with a pullback. And 2 out of 3 times is significant, and it's large enough to force us to consider this may be a risky situation, and so we have to consider that a profit must be taken if a pullback begins to start. And to do that partial exit, so we consider in fact a portion of the length of the bar in order to define an exit level, and if the price indeed pullbacks and hit that level, we make our MX. We close 1 unit. You can see in this example that we have 2 long bars. This bar is also a long bar, giving another nice partial exit or total exit depending on the decision and the number of units we have in that trade, depending of course on the scalings we can make along that movement. Observe, by the way, that we can combine these different exit techniques. We have here the 2 long bar situation, but we have also 2 successive divergences later at the top of this movement, with higher highs in the price and lower highs in the RSI. So a long bar is always a nice opportunity to bank a partial profit. And as I have said, very, very often the an MX made on a long bar will set in combination with the stop loss adjustment, and we have rules to adjust the stop loss, of course, will set the trade in a risk-free situation and sometimes in a guaranteed profit situation. The third tip I would like to illustrate is, and I have illustrated in fact, is the fact that we take a partial profit. Indeed, the MX or momentum exit is an important concept in the max trading methodology, because as you will see in further example in a moment, we have a scaling process which in fact consists in adding to our position to progressively build a larger position. But whenever we make a scaling, whenever we add to our trade, whenever we make the trade larger, we introduce more risk for the resulting position, and we have to control that risk. And one way to control that risk is, of course, to adjust the stop loss along the trade, but also to make this partial exit banking some profit or limiting some losses. And so this partial exit is a very, very important component of our trade risk management. So there are other rules to control the risk management. For example, when we consider the scalings, we do not make scalings whenever it is possible. We have strict conditions to make these scalings in order, again, to control the risk we are handling. So, okay, now let me show you some of the concept of the max through a very recent trade example. So, if you remember, I have said, and Craig has mentioned also, that the max is a trend following system. This was a trade a few days ago, last week, in fact, on the pound yen. And the different trades I'm going to illustrate, so are made with here the max ETF primer, which is our most basic level of the max. With that trade, with that movement, we have, of course, a template which displays all our indicators. I'm showing just some of them, but an important indicator is this red and green line at the bottom of the screen. This green and red line is called the slow bias or the companion indicator. And this indicator gives us the technical bias or the technical directional bias we have to consider to trade. And so this means that whenever we see a red line, we will consider only short trades. And whenever we will see a green line, we will consider only long trades. But this is simply a technical bias, reflecting, mirroring what the price is doing. And what we have introduced recently is the third pillar of the max, which is the global context, in a more formal way than we were doing it in the past. And we call that concept the max advantage bias. And I will illustrate the max advantage bias a little more in details in a moment, but globally the max advantage bias takes into account the geopolitical events, the news releases, the central bank decision, so any factors outside the market itself which may have an influence in the price movement. And so we consider, so in that case, the geopolitical phenomenon, the macroeconomic factor, and the fundamental factor in order to decide every day in which direction it's better to trade, in fact, each currency. This max advantage bias is based on the currency themselves. But when you have the bias on two currencies, for example, the pound and the yen, you can decide the direction to trade for the pairs. And that day, in fact, the bias for the pound yen was to trade the pound yen short. And so we consider only short trade. And when do we make this short trade? Of course, when technically we have the short bias, when our companion indicator is red. And so knowing that we have to go short, we will wait for what we call a short entry setups. And we have several types of entry setup. We have entry setup at the beginning of a new trend, and we have entry setup later along the trend. And depending on the level of the max, we will have more or less entry setups. And so for the max ETF primer, we have one entry setup, which is called, by the way, max ETF safe and perfect mode setup. And so this is an example of such an entry setup, a safe and perfect mode setup. For each entry setup, we associate, of course, a stop loss, which defines our maximum risk we accept to take on that trade in terms of pips, but also through the size of the trade in terms of percentage of the trading account, for example, a 1% or a 2% on the trading account. And then once we have opened the trade made of 2 units, we wait for our different exit setup. And we can see here that just 2 bars later, after the entry, we have a long bar. And this long bar, as I have explained a few moments ago, is a nice opportunity to bank some profit. And in this case, so we bank a profit on 1 unit of 18 pips. And you can see that if we don't adjust the stop loss at that moment, these 18 pips almost balance our stop loss. So the trade is almost risk-free at that moment. We have just to see the price moving 4 more pips plus the spread. Unfortunately, the spread is very small with the platform I'm using here. Later on, the next exit setup happens on this candle, which happens to be also a long bar, and so we can make another exit. But because the Max ETF Primer does not take into account the scaling process, we were left with 1 opportunity. So when we have to make that second exit, we have to close, to make a final close, a full exit of this trade. And so in total, we have made 18 plus 46 pips profit, representing a total of 64 pips, which represent a reward to risk ratio of plus 1.45 hours, depending on the size of the stop loss. So in order to calculate the reward to risk ratio, we have to divide the total number of it by 2 because we are using 2 units. We need to calculate the average results of these 2 units, and that average result is divided by the stop loss side, and this will give the correct reward to risk ratio. Now this seems to be a small reward to risk ratio, but if you trade with a risk of 2%, R represent the risk. I'm using the Van Tarp notation, so the R notation. R represent the risk. If R is 2%, this trade alone represents 2.9%. If R represents 1%, this trade represents 1.45%, which is a decent result in the Forex, by the way. But later on, the price resumed the downtrend. And here we have another entry setup to go short, so we can open a second trade. And then 2 or 3 bars later, we have an exit setup triggering, allowing us to close 1 unit of that second trade. And the trade is always associated with a stop loss. And then a few bars later, we have another exit setup triggering, closing finally the second trade for a total profit of 47 pips and 1.18 R. And later on, a few bars later, we have another entry setup here to go short. And then here we have a unique exit. We have some guidelines which tell us when we have to make a full exit, whatever the number of open units we have. And this kind of tips is based on the general behavior of the price movement. And so here this third trade made a profit on the 2 units of 44 pips, representing almost 3/4 of 1 hour. And you can see that day, thanks to the fundamental macroeconomic bias and the technical bias, we had on the pound yen during the European session only 3 available trades, and they were all profitable trades for a total of 3.39 hours profit. And I remember that for a 2% risk, these 3 trades represent a 6.8% profit, which is a huge profit for the day. So, of course, this trade or this trend has given 3 simple trades, 1 entry and 1 or 2 exit per trade, but it was the Max ETF Primer. When we consider now the same movement with the Max ETF Standard, which includes the scaling process, we obtain something completely different. In fact, this is now the trade with the Max ETF Standard. Of course, the Max Advantage bias has the same directional bias. We have to go short, of course. We have possibly the same entry setup. We may have a different entry setup, a usually an earlier one because with the Max ETF standard we have more entry setup either at the beginning of the trend or later in the middle of the trend. But now the entire movement represents just one trade with several scale-ins. So we have our entry setup with its stop loss. We have a first partial exit due to the long bar here. And then later, instead of waiting for the second exit, we are able to make a scale-in. And whenever we make a scale-in, we add 2 units having the same size as our initial entry. And of course, the fact that we have closed previously one of the previous open unit, we reduce the risk on the entire position, but we have now 3 open units instead of 2, or instead of 1. And if we adjust the stop loss, we have a better control of our global risk now, because the size of the position is increasing by 1 unit. Later on, we have a second exit here, followed a few bars later by another scale-in. Of course, we continue to adjust the stop loss. Note that the 2 partial exit has closed the 2 units of our initial entry. We comply to the FIFA rules, which is imposed by the US regulator, but by also many brokers in the world. And after the second scale-in, we are able to make another partial exit, followed with another scale-in, then another MX, then another MX. You can see we may have 2 successive MX, which is not a problem because we have enough open unit through the scaling process. And then at some point we have to be attentive not to add too many scale-in to the trade due to the risk which may possibly increase. Even if we control it, the risk can possibly increase somewhat, but also to some timing consideration. But nonetheless, in this case, we have the possibility to make a last scale-in, a 5th entry or 4th scale-in, and then the same final exit as in the Max, with the Max ETF primer system. So you can see here, so 5 successive entries and 7 partial exit, and then a final exit with 3 remaining open units. Now, when we accumulate all these units, we get a different result. Now, the total number of pips is 420 pips of profit, but as you know, the profit in pips is not significant. What is significant is the reward to risk ratio, and the reward to risk ratio is in fact plus 12.35 R. 12.35 R. With a risk of 2%, this represents a 24.7% profit on your account with just this trade in 1 day. Even with a 1% profit, this represents a plus 12.35% profit, to be compared with the 3.39 reward to risk ratio of the Max ETF primer. So through the scaling process, we have been able to multiply the profit of the Max ETF primer by 3 or 4. It will not always be the case. The improvement of the process of the profit is between 30% and 300%. This is an example when the profit has been multiplied by more than 3 compared to the Max ETF primer. And if you are experienced enough with compounding your profit, provided you are profitable, of course, you know that if you have the possibility to make an average profit of just 0.5% per day, and provided you trade every day of the year, which is a strong assumption, I can recognize that. But let's suppose we can, just to have an idea, we can trade every day of the year, and we are able to make a 0.5% profit, so 0.5% profit every day, and you compound your profit at the end of the year. With no withdrawal, you will multiply your account by 3. If you are able to make 1% profit, and you see that with the Max ETF standard level, it's not so hard to make a 1% profit. It's even a small profit. But if you are able to make on average a 1% profit per day at the end of the year, by compounding your profit, you multiply your account by 10. By 10 if you make no withdrawal. And so you have a lot of flexibility with the Max ETF standard. So, A quick other example is, for example, the pound CAD, a little more in the past. So in this uptrend, it was now an uptrend. So with the Max ETF Premier, so we have one entry and two partial exit. And so you can see the type of reward to risk ratio we obtain, and the trade has exactly the same structure as in the previous example, but now we are in an uptrend. But this same movement with the Max ETF Standard now gives a complete different result through the scaling process. Again, we have one initial and earlier entry, and we have one, two, just three successive scalings, and 1, 2, 3, 4 partial exit, and the final exit closing the 4 remaining opportunities. We can count how many units we have at the end of the trade. We have 2 units for the first entry. We are left with 1 after the first partial exit. We are 2 units on the second entry, so we are left with 3 open units. We make another scaling, so we are left with 5 open units. We make 2 successive MX, so we are left with 3 units. We add 2 units, so we have 5 units. We close 1 unit here, so we are left with 4 units, and so these are the 4 units we are closing for the final exit. So counting the remaining unit, it's always easy. Whenever we make a scaling, we add 2 units. Whenever we make an MX, we close 1 unit. But now you can see that the result for a rather small movement is 7.37 R, so 7 times the result of the Max ETF Primer. The Max ETF Standard through the scaling process makes a huge difference. So I have illustrated the example with pairs, and in the 5-minute time frame, but we can trade any instrument. This is an example of the Standard & Poor's 500. It may be, for example, the ES contract if you trade in the futures market. You can always make your analysis on the MetaTrader platform. Even on a NinjaTrader platform, we have also our templates and indicators for a NinjaTrader. Chris will explain that in a moment. So you can trade, for example, this is an index, the S&P 500, so the ES contract, on the daily time frame. And you can see that the trade has exactly the same structure with the Max ETF from a 1 entry, and in this case we had just one full exit for a result of almost 1.5 R. And with the Max ETF Standard, with the same movement, we were able to make an earlier entry, and you can see first entry, scale in, 1, 2, 3, 4 partial exit, and then the final exit, giving a difference which is a huge amount. So we multiply the result by almost 6, approximately 6, with a nice 10.67 R profit. So we can trade also commodities, gold, oil. We have some max member trading these instruments. So you can trade any financial instrument which is tradable with enough liquidities, of course. And of course, I have not an example here, but we don't have a 100% winning rate. We have also losing trade. Globally, the max, if we don't take into account the global context, provide a winning rate of around 70 to 75%. With the max advantage bias, so the global context, the winning rate climbs over 80, 85, even 90% winning rate. But when we have a losing trade, the losing trade is either break-even or giving a small loss. And when I say a small loss, the order of magnitude of the loss is around minus 0.5 R. So very small compared to the result of the Max ETF Primer when we have a winning trade, or compared with the Max ETF Standard when we have also winning trade. So minus 0.5 R against a 1.5 or a 10.6 R when we have a winning trade. And so knowing the winning rate, the losing rate, and on average the reward to risk ratio we get when we have a losing or a winning trade, you can calculate the expectancy, and for the max, the expectancy of the trade is very positive. So the max, in fact, provides a trading method and concept that works. For example, I have talked about the trade risk management. This is certainly an approach which is used by professional traders, even the big boys. So the big boys, I name big boys the traders in banks and in important hedge funds. The global context is also an important component they are using, and in the course we explain why these concepts are working. And the technical aspect is more developed than what the big boys are using. It is often said that the big boys don't use technical analysis, but there is nothing more wrong than that. The traders I have seen in some important banks in Europe are using some kind of technical analysis just to time their entries and their exit. And when we know how they trade, it's easier for us to define how to consider our trade. So we have three important pillars in the MAX methodology: the technical analysis aspect in order to time as correctly as possible our entries and our exit, the trade risk management and the money management in order to control the risk when we are in a trade, to reduce and possibly to cancel the risk when we are along the trade, and which risk to allocate to the trade, and then the global context in order to define in which direction we have to trade in order to be sure or surer that we are trading along the big boys. So method and concept that work with the MAX. And so I have talked about the money management. The training we provide, in fact, have the aim to reinforce your trade skills. And one important aspect in that training, and Chris will be more detailed about that aspect, is the homework. After each session, we assign a homework to the students in order to be sure that, not for us, we are not interested to be sure that they apply the MAX correctly. Of course we are interested, but it is not the priority. The priority is for the student himself or herself to be sure that the concept and the rules are applied correctly. Because it's amazing to see how sometimes some concepts and rules are misinterpreted. And this is why we always pay attention to that aspect in order to progressively improve the way we teach the MAX. I have said previously that I would talk a little bit about the global context, and so the global context contains, first of all, some or as many geopolitical elements which may influence the market. And this is an excerpt of some of the geopolitical elements we consider. They are available in our website free of charge, so you can access, even if you are not in the MAX community, you can access these informations. For example, a typical geopolitical event which is still holding for the moment is the Brexit with the UK, but also all the decision of the Fed. All the traders are following with great attention all the decisions taken by the Fed, and some other, another very important event is, of course, the coronavirus all around the world, which have not only an impact in the market we are trading, but also in the economy. So it is important to follow, to closely monitor all these elements. Then another important information in terms of fundamentals we provide, especially for traders who trade with a small time frame, is a better economical news release calendar. If you follow a calendar like Forex Factory or any other types of economical calendar, you will have many of news releases, but not all are important. In the course, we explain what are the important news, and when an important news will generate an important movement in the market. And so our news watch list, in fact, our calendar, pinpoint only for each day of the week, and this calendar is updated every week. It pinpoints only the news which are really important. So, for example, it's clear that the CB consumer confidence for the US dollar is an important news release. The durable goods order in USA, it's an important news release. The GDP and essentially the advance or preliminary GDP in USA is an important news release. So we have to follow them extremely with extreme attention, so but only those which are really important. And then because the MAX is a trend following system, we also provide to our members, but also non-member, because this information is free, what are the pairs which are the best moving pair. Better a pair is moving, better the trend will be, and better the result will be with the MAX. And so every week we provide a list of these best moving pair. And this is a crucial element because for several years now, 6-7 years, we are observing that the average daily range is progressively decreasing. We are at a very, very low level of the average daily range for months and months now. And this is why we need to be extremely attentive in our trading process. It was usual, for example, for a pair like the pound yen 10 years ago to have an average daily range in pips of 300 pips, 400 pips. Now when we have 100, 120 pips, we must be happy. So this is why trading the Forex is becoming or has become progressively more difficult. But with the MAX, we have no problem at all. We can take profit even from a movement of 20 or 30 pips. So, and then when we associate these pairs with the previous calendar, optimized calendar, we are able for every week to propose a smaller list of pairs to monitor and to trade for every day of the week. For example, last week on Monday, the best pair to consider were the pound US dollar, the euro US dollar, the pound yen, and possibly the pound kiwi and the pound Aussie, and similarly for each day of the week. All these informations are given for free, and you can access it through our website. Let me show you our website. So here, so at maxtradingsystem.com/newswatch, or if you land on our homepage, you click on the Newswatch list button, and you will see that page, which is updated so every week. So with the geopolitical elements, you see that the list is important. Then the calendar with only the significant news for the week, and then the best moving pairs, and then the pair to monitor in priority in order to increase, importantly, the odds to have a trending pair, because this is essential for a trend following system. And when there are no movement at all, because this sometimes happens, when there are no movement at all in this pair, there is another list of pairs which gives usually smaller movement, but which may be sometimes more regular. Smaller movement, but regular movement. And so we give an alternative list, which is also very, very interesting to consider. And then we give some explanation on how to exploit, to interpret the information we give on this page. And then, if you are interested, you can see what were the information on the previous week, and then on the week before that. And so the page allows to display, I don't remember how many weeks we have, so, but every weekend, every Saturday, or Sunday, we update so that page. The second element we give to our trade, but not free of charge, and so there is a small subscription for that, is what we call the bias. And let's come back to my PDF. So here, the directional bias, so the max bias advantage, so which indicates in which direction we have preferably to trade based on these geopolitical elements, fundamentals elements, macroeconomic factors, and so on. And so when we see up green arrow, and we may have 1, 2, or 3 depending if the bias is strong or risky. So when we see so up green arrow, this means that we should consider only long trades, and when we see down red arrow, we should consider only short trade. And you can say depending on the pair or depending on the instrument, so we have different direction. And so we consider here a certain number of Forex pair, but also 5 indices, the S&P 500, the Dow Jones, the Nasdaq, the German DAX, and the UK FTSE 100. 2 commodities, gold and crude oil, and so the US Treasury bond, in fact it is the 10-year US Treasury bond, and the Euro bond, and sometimes when I have the time I also include the VIX of the S&P 500, because this helped me to have also a very synthetic global view of different markets, because there were also correlation between the markets. So this improved, in fact, the definition of the global context directional bias. And these bias may change over the day depending on the event, so we may have several changes. It happened that day, it was last Thursday. Usually the Friday I don't produce the bias because I take my Friday off. We may have several changes in the bias. That day there was only one bias, but these bias are valid only for the short-term traders. So trader trading small time frame, 5 minutes, 15 minutes, 30 minutes, 1 hour. We have also long-term bias. So for the traders who trade higher time, 4 hour and higher, for the 28 pairs made of the 8 main currencies, the same 5 indices, the 2 commodities, and the same, so bonds and VIX, in such a way that long-term trader will have also a good idea in which direction they will have to trade. So an up green arrow represents only long trade, down red arrow represents short trade. And this information is available only through a subscription. And so we have a Google Sheet which gives, so in 2 different sheets, so either the short-term bias, the Google Sheet is empty for them because we clear it every day before each beginning session, and Friday there has been no bias produced, and then the long-term bias. Whenever a change is made in the bias, either in the long-term or in the short-term bias, there is, let me show that again in the PDF, there is a timestamp which is set automatically as soon as the bias has been changed, in such a way to record when the bias has been defined, in such a way to make backtesting, for example. So, and this is true also with the long-term bias. Whenever a bias has changed, we provide automatically the day and the time when the bias has been changed, in order to check later on if the bias are good. And they are really very, very good. So my aim with these biases is not necessarily to achieve a high winning rate. My winning rate in having correct bias is around between 60 and 80%, but which is not necessarily a problem. When the bias does not correspond to the price movement, there may be several reasons. For example, it may be an error in my bias. Perhaps I have misunderstood some important element in the global context, or sometimes the price will react later to the bias because the market is manipulated. You know that the big loss are able to manipulate the market, and so sometimes this happens. And so we need to be patient until the price moves in the direction of the bias, which is in fact the intention of the big loss. But when we trade in agreement with the bias, the winning rate of the trade climbs or rises to between 80 and 90%, and this is really, really a huge, huge result. So, well, so every Max courses we provide, and today we propose you only the 2 level I have just illustrated with the Max ETF Primer and the Max ETF Standard, will provide, in fact, confidence in your skills through the way the Max is taught, and through the homework, and through the other activity we have after the course, and quiz will be a little more detailed about it. So, for example, we have the mentoring aspect with our practice session, the homework, and sometimes some free workshop. So we propose today the Max ETF Primer Course, which is just a simplified version of the Max Standard, and the Max ETF Standard course is our flagship course, which contains, in fact, the entire process of the Max with the scaling process and a solid trade risk management and money management. So, and of course, both include the different bias, so the technical bias with the companion indicator we call the slow bias, and for those who subscribe to that, the Max Advantage bias, which take into account the global context. So, and now, Chris, I will give the mic to my friend Chris, who has some very important information
Hey, thanks, Eusebio. What I'm going to do here is just briefly outline some of the information that, just to reiterate what you're going to get out of the course. As you can see, my name's Chris. I'm a partner with Eusebio and Craig in the Max. We've been running this for over 12 years now, and this is our 70th set of courses. We don't run them very often, so this could be the last one for the year, especially with COVID floating around. We've trained over 2,000 people, and if you want to jump into Forex Peace Army, we'll send it out later, the link. You'll be able to see some of the results, some of the reviews that people have written about us. What this is all about generally for people is that they get some sort of income security, some retirement income, are able to look after themselves. These days, there's an added dimension to it because things are quite fraught. People losing jobs all around the place, not knowing if the businesses are going to hold up, being beholden to your boss or the corporation or the business or even just the industry that you're in. Here in New Zealand, where I am, our tourist industry has been completely pretty much wiped out, and we're just relying on internal tourism because we're not allowing anyone through the borders. So a third of our GDP comes from tourism, and that's just been wasted. So we've got several tens of thousands of people looking around for jobs now. So if you're in that sort of situation, or likely to be, or something else happens along the COVID lines or some other disaster, I know this is all bad news, you need something to be able to fall back on. And if you're able to trade, then you can do it from your home, from your laptop or whatever, at the time that suits you, and be self-reliant. The question is how you're going to get there. There's plenty of systems out there that are not that good. They're just simple moving average crossover type stuff. I used to trade with those. If that's what you're doing, just a real hot tip here is that information that Eusebio was showing you before about our Newswatch page. It's free, you can use it at any time, and will keep you out of a lot of trouble. Okay, so what we've put here together with the Max Trading System, and lots and lots of kudos to Jim, because he put together a really amazing system back in 2007, and Eusebio has built on it consistently, so it's a rock solid platform, is a really professional system. So some of the challenges, as you've seen, that you get, and is how to tell when to get into a trade, and also really importantly is how to tell when to get out of a trade. With the standard, with its advanced, very, really good money management side of things, if the stop gets hit, most times from a very short period on after the start, you're guaranteed a profit. But if the price goes against you and slams up against your stop, you don't lose your money on it. Okay, so some of the challenges that the trader has is poor price action, shot, sudden large movements, spikes, and we had that quite a bit when the market was crashing earlier this year, trying to figure out which direction to go in. Eusebio has revamped things so that we're much better odds on picking the direction that the price is going in, and especially when you use this pair bias advantage, the odds on you getting into a winning trade go up hugely, like another 20 to 30%. You've got all these challenges going against you. With the price action, like the consolidation, the chop, am I in a trend, which way is it going? We can help you with all that sort of stuff with the primer, and as well with, of course, with the standard. The primer is just a simple subset of the standard. So what we do is Jim put together a really good system, and like I said, Eusebio has added to it so that you can tell and you can adapt to whatever the market is doing. So it doesn't matter if you're in a trend mode or a counter trend or it's in a breakout situation. We have rules and criteria to set yourself up for it. This is just kind of covering everything that we've already done. So in order to do that, we've got really precise and very detailed setups. So on a 5-minute chart, if you're trading it, you'll see the setup, and then you take action on the next bar generally, and within 1 or 2 pips, so long as price is moving in the right direction, 1 or 2 pips later, you'll be placing your order. And in order that you get the most out of this course, we ask you to do homework. Like I said, it's not just a PDF or a video. We want to make sure you actually understand it. This gives you practice of what's actually happening, so you get your hands dirty. It's not just something that you read about and then you try and do. It's something that you practice with first that gets embedded in you before you actually go out into the real world. Somebody wrote on his homework, I hate homework. However, I've come to realize I have a tendency to grade myself on a large curve. So he has a more optimistic view of himself. So he said the objective feedback is awesome. So he really found it helpful. So what you're going to get from the course is everything. There's nothing else to buy. So you get the full system, all the materials, templates, examples, training on how to use the platform itself. But whenever you need help, we'll be there to answer, help you and answer you. So there's no extra charge for any of that. We try to do our best for you. As I've mentioned, we've got the high probability entry setups. Generally 65% on the smaller time frames, can be up to 90% win rates on the higher time frames. Bottom line, what you're going to end up with is a really powerful and safe trading method. As Eusebio mentioned, we're offering two courses today, the Standard and the Primer. The Primer is a subset of the Standard, so if you took the Standard, you get the Primer anyway. It's a simple buy and sell system with a simple money management. The Standard course runs for 7 sessions, and even though it's longer and has more in it, it's actually easier to learn than the Primer. With the Standard, you also, like I said, you get the profit acceleration, which is what really kicks things in. For people that are just break even at the moment, just making a bit, losing a bit, making a bit, losing a bit. If you take the Standard and use the profit acceleration side of things, profit acceleration can be enough to boost people over that just break even point so that they become profitable. And with that, they become a bit more relaxed about their trading. They're able to see things, not panic so much on the entries or the exits, and a lot more comfortable because they know where price is going. So the Standard course runs for 7 weeks. It starts on September the 10th, like in a week's time, and normally it's $299. This webinar special is for $2,399. The Primer course itself just runs for the 2 sessions, like I said. It has the homework. You still get the practice sessions afterwards. You don't get as many entries. You don't get as many exits. It's still safe. It's still profitable, just not as massively profitable as the Standard is. And the normal price is $329. Webinar special is $159. I'll leave these up here with our contact details at the bottom. Coming up this week, we, as Craig mentioned at the start, Eusebio will be running a live session if you want to come along and see what we're about for the US session on Tuesday. So you'll get an invite to that. Siva says, my understanding is it correct that the maximum drawdown is a half R in all cases? You get into a trade and you risk 1% on your account. The half R would mean that if price slammed back against your stop, rather than hitting your stop, which we use for emergencies only, like if your power goes out or something, we have a stop halfway between the entry and the exit. So that's where we get our half R. You would only lose 0.5% in that particular case. So even though we do all our calculations on the full stop, we still get out way before it's hit. And our stop that we place when we place an order is there for emergencies only. We want trades to be as riskless as possible. Do you want to comment any more on that, Eusebio?
Yes, indeed. I have an additional remark to make. We have always to make the distinction between the drawdown on the trade and the global drawdown on the trading account. Indeed, on one specific trade, when it becomes a losing trade, the average drawdown, the average loss is minus 0.5 R. But of course, you can always experience a losing streaks. I mean a succession of losing trade. And let's suppose you may have, for example, which is not especially exceptional, 10 losing trades in a row. This may happen. It's a possibility. You have never to neglect. So, and we explain that in the course also, and why. So, but let's say 10 losing trades in a row. So this means you will experience a drawdown of approximately 5%, which is still a small drawdown. And you have seen through the example with just one good max ETF standard trade, which happened rather regularly, you can easily recover that drawdown and even be profitable. So never mind to have losing trade. Losing trades are not avoidable. We can, with the max, avoid many losing trades, unfortunately, not all of them, and we have to embrace them. Once you become a great loser, you will become a great winner. And so this is a paradox, but this is the reality of trading. So never fear to have losing trade if you apply the trading process correctly, of course. This is an important requirement.
Okay, thanks, Eusebio. And Tim, I think, asked, what happens if I'm not available for the courses? All the courses can be done by video as well. We've got people, like we run them at 4 p.m. around about this time, each training session. Some people are not able to be here at this time, so they're all recorded, and you get the recording straight afterwards, along with all the notes and the PDFs, all that sort of stuff. And about 60% of people, I think it's that much, around the world do the courses by video, so there's no problems with that. There's been several people that have got work issues get on the road, or they're sick or something like this, that can't do the course but take it up afterwards. There's no problems with that. So you just go through the videos, still send in your homework because it's still important. We don't have any limits on the amount of time you have in order to do your homework. So just send it in. In fact, earlier this year, I was still doing homework from people from last year. So we want to make sure that you actually succeed with this and that you understand what's going on. So we try and adapt as much as possible to you.
We have one important concept in the Max team. Never ever be shy to ask a question or to send your homework. We are always there to help. This is our mission, and there are no dumb questions. So every question may be extremely important.
I don't know, Eusebio.
Sometimes the answer can be dumb. So
I've heard you say some of my questions are dumb, but hey. Cheers, Con. And okay, okay. Do we have a trading room? It's been asked by Pips. No, we did. Well, every now and then we have live trading sessions. So there's one coming up on Tuesday. So yes and no. We don't have a trading room where we give out trades or anything like that. Really careful of that because of the legal situation. You need to be licensed in order to do that, and we are not. So we don't want to be seen to be giving out trades or anything. Does the chart? I think we're pretty much done with the questions, Eusebio.
Okay.
The only main one that comes up most often is, how do I tell the difference when price is in a choppy mode, or is flat, or is about to start trending? And I'll leave that one for you to answer.
Yeah, okay, with pleasure. In fact, in the two courses, the primer and the standard course, we teach what we call the price modes. And the price mode consists precisely in recognizing the market conditions. And so we have two main categories of price mode, the local price mode and the global price mode. In the local price mode, we make the difference between the trend mode, the counter trend mode, and the consolidation zone mode. And we have precise criteria to define in which mode the price is moving. When the price enters, evolve, and then leave the specific price mode. And then in the global price mode, we make the distinction between choppy mode and what we call a spaghetti zone, which is a kind of combination of a tight choppy mode and a concession zone mode. And this is important to recognize each of these price modes because the way to exploit an entry setup and sometimes an exit setup depends on this price mode. And this is extremely important. We don't handle an entry setup in a concession zone mode like in a trend mode or in a counter trend mode. And when the price is moving in a choppy mode, and it's not very difficult to recognize the choppy mode, then we need to handle the trade in a very, very specific way in order to optimize the result we can obtain from a trade in a choppy mode. Because the choppy mode may be sometimes extremely complex to handle because by definition the price will have an erratic behavior. So it can make a medium movement or it can make a very small movement before reversing. So the price mode is a key concept in the MAX. So it defines the market conditions, technical market conditions, of course.
Okay, thanks, Eusebio. John has asked, can this work on platforms other than MT4? Yes, but you'll have to get the indicators ported. However, the overall method itself works on anything, really. So it doesn't really matter what the platform is. The underlying core concepts of the MAX will work. You can even use it on weather charts if you are able to get the information out correctly. But to make it work on another platform, the indicators will need to be modified in order for them to work on those platforms. And we've got no problems giving them to you. The concepts for the indicators, like the moving averages and things like that, are pretty simple and are in other platforms naturally. We've only got a couple of indicators that are quite particular to the MAX. In fact, having gone this far, Jim came up with an idea which operates like magic, and it's dynamic support resistance levels. So the primer doesn't get them, but the standard people do, and they can tell before they even start the chart up how far out the price is likely to go and where the target prices are likely to be if price sort of suddenly takes off. So they're really quite amazing. They're really great for knowing that you're in a good safe trade or when things are getting a bit risky and you need to sort of get out of things. Okay. I think I've done enough on that damage on that side of things. But yeah, we do have a magic indicator. But you have to take the standard to do that. But we will give you all the information on how to get that into another platform as well if you want it. Okay, so I think it's about time to wrap up. I'll let you do the finishing up here, Eusebio. Perhaps I'll see you on Tuesday, but it's after midnight for me then, so I'll probably be in bed. And just a reminder about Tuesday coming up this week and non-farm payroll as well, Eusebio. You've got a busy week.
Yeah, no, it's not a very busy week for me because we had the presentation, and then next week we have only the live sessions, and then the course will start the week after. So it's not a very busy. It will be a busy week for me for for trading, of course, but not for the activity aside with the MAX. So I would like to thank you very much for your participation to this presentation today. I thank you also all the person who will follow or will watch this recorded video. The recorded video will be available in around 24 hours and will be sent by Craig with all the necessary informations and links to enroll. And I hope to see you in one of these courses. I'm very, very grateful for the kind word you have mentioned, you have written in the question area of GoToWebinar. And on that, of course, I wish you a great rest of the weekend. And for the next days, trade safe, trade smart, trade safe, and I wish you a lot of success in your trading process. So, and see you soon. And in the meantime, stay safe and take care.